Hey, everybody. So I'm a debt investor. I'm a lender and a debt investor, meaning I lend other people's money and I lend my own money secured by real estate. And so what I have, I think, in terms of my private lending practice, is the simplest approach to investing in debt. And that approach is lending loan by loan or asset by asset. Some people call this the trust deed model, as opposed to a debt fund. A debt fund is a big pool of loans, say 500 loans, and you've got exposure to all of the loans, right? That's a debt fund. And there's pros to that, pros and cons. One of the pros is the risk is dispersed, right? One of the cons is you don't know all those loans and you don't know the underwriters, and the list gets a little deeper than that. But the way I like to do it, at least for now, is I like to lend for specific properties that I understand the asset, and for specific borrowers that I understand them, right? And, of course, I've done, over a decade of being a mortgage broker, and that's lending other people's money, other institutions' money. And those guidelines are set by Fannie and Freddie, essentially. Now, there's been plenty of non-QM and bank statement loans and stuff like that, but the bulk of that practice being a mortgage broker is FHA, VA, USDA, and conventional loans. And those rules are set. Those rules are pretty clear on what you got to do to access that capital. What I like about my private lending practice is I get to decide, right? Now I decide for me. I'm the biggest funder of my loans, right? It's mostly my money on the line, but I've been investing other people's money alongside of mine in these notes. And it's very, very simple. It especially works for me and my crew because we're all real estate investors, right? We've all been at it for a decade or two, and everybody likes to look at the deal and understand the deal. And so the deal is pretty simple, right? I lend to flippers and farmers. That's it. Flippers and farmers for short-term bridges, right? 3 months, 6 months, all the way up to 12 months. And that's it. That's the private money I lend. So flippers, for example, I've got a great crew of flippers. I lend them money at 70% LTV, 70% loan to value at acquisition, right? When they purchase it. And then they take all the responsibility of bringing the funds for the rehab. And when they're done remodeling that property, my first position lien is now somewhere between 50 and 60% loan to value, or LTV of ARV, loan to value of after rehab value. And I find that to be quite safe for me. I'm very comfortable with that. I'm also comfortable if, God forbid, I had to take that property back for whatever reason. Let's say one of these borrowers crawls into a bottle, goes to Mexico, dies, something horrible happens, and I have to go take that property. Well, I only lend in places where I have, legal infrastructure. I have the attorneys to go take that property back. Obviously, we're papered up with, personal guarantees and deeds of trust, and the notes are solid and all that. Um, and me and my partners are comfortable taking that property back if need be. Now, knock on wood, never had to do that. Hopefully, never will. But if you're going to lend money, you have to be comfortable with that asset, right? So I'm comfortable doing that with farms with my good partner, Bo. I'm certainly comfortable doing that with residential real estate, in Colorado, right? In Texas, in places where I've personally invested and know the markets. So it's really that simple. So when I invest, let's say I did a loan for a flipper last week. It was a $200,000 loan. I lent him the $200,000. It was 70% of the acquisition. And then this week, one of my buddies calls me and says, "Hey, Chris, I want to invest in loans too." And so what I'll let them do is take a portion of me out, right? So they come in and they say, "Hey, I want to invest $100,000." And I say, "Hey, I've already done this loan. Do you like it? Here's everything you need." You look on the data room, you see the pictures, you see a podcast with the flipper himself, a 30-minute video I do on the deal, a 5-minute video I do on the deal. Look at Google Earth. We look at, look at everything. All the title docs are on there, the contract, any amendments, obviously the loan docs, deed of trust, personal guarantee, note, all that stuff. And so an investor can get in there, look at the data room and say, "Hey, I like this." And if there's room, I'll let some of my good friends, some of my tight network take me out. And so I can have money to go do the next one, right? Because I have a war chest, but it's not a big war chest, right? And so I'm comfortable investing in these, and I have my little crew of it that is also comfortable investing in these individual notes where they know the specific asset and the specific borrower. Um, and I think that is the simplest way to go about it. Now, there might come a time where I run a debt fund, and I think that would be fun. But this way, this way I get to be a sniper, and so do my investors. We get to be snipers. We get to, vet the deal ourselves. We're not outsourcing underwriting. Um, and some debt funds offer a little upside if they have to go foreclose on the property. We of course would do that as well, right? So there is upside if you have to take a property. There's default interest, which is higher than the interest rate you're lending them initially, and there's penalties, and then obviously there's hopefully meat on the bone if you do have to take that property. So you could argue that there's upside to the borrower failing. However, that's not our business plan. That's not our model. We don't want to do that. We want to support our borrowers in every way, shape, or form. And but that being said, if it goes down, there is some upside. Now, not all debt fund folks offer that upside. I think it's easier. I would just argue that it's easier to do when you're doing one-offs, right? Now, one-off, you're exposed to one asset as opposed to a fund where the risk is dispersed. So anyway, the liquidity generally the same, and I can't speak for all debt funds. I only know maybe a half dozen debt funds. But liquidity on a flip, like our avatar flipper, his exposure to these deals is 127 days, and that's an average taken over 14 years. So you're in it generally for 3 or 4 months. When we lend bridges to farmers, it's usually 6 months or even 12 months. Farming moves slower. But yeah, every private loan we do is, 6 months term for flippers, and there's no prepay, so they usually get out earlier. And then, 6 to 12 months for farmers. And that's it. I think that's as simple as I could make it. I mean, I guess you could have a simpler, I lend my buddy, a personal loan with no collateral. Okay, that might be simple. But in terms of lending money secured by a real asset, real estate, I think this trust deed model or the individual one-off kind of sniper model is as simple as it gets, and it's not complicated by having 500 loans. It's not complicated by having a whole team of underwriters and team of originators. This is just one off, snipe it right down the center. So I hope that makes sense. Let me know if anybody's got a simpler debt investment. I want to hear it, because I like debt. I think that's a very safe place to be, at least right where about what I do every day. And I think I've got the simplest model, but let me know. Let me know if you got something better. All right. Hope you're all well. Take care.